Leah here. Have you noticed how badly the US dollar has been doing this year? If a 10% drop doesn't sound like a big deal to you, well, think again. This isn't Bitcoin we're talking about. This is the global measuring stick for everything from oil to interest rates. And when that stick shrinks 10%, it's like all assets around the world just magically got a 10% bump. So, doesn't that feel like cheating? It's not a joke. Just look at the dollar index for the first half of the year. It's had its worst 6 month stretch in nearly 50 years. And at the same time, asset prices across the world have been exploding like they're on caffeine pills. Gold has gone ballistic. Bitcoin, well, Bitcoin's always on something. And equity markets, US, Europe, China, Japan, you name it, they're all up. Here's where it gets weird. The dollar used to move hand in hand with the key metrics like the S&P 500 and the 10-year Treasury yield. When the dollar went up, so did stocks. When the dollar dipped, bonds followed. But around May, that pattern shattered. Suddenly, stocks were parting on their own while the dollar was left behind sulking. So what happened? Why did they split? Let's bring in some charts. Historically, the dollar and S&P 500 showed a strong correlation, but after May, the S&P kept climbing while the dollar crashed. Same story with the 10-year yield. And now, the S&P 500 seems to be cincing with a mysterious new index with an insane 82.4% correlation. What's this index? It's not front page news, but it's controlling the whole show from backstage. This growing divergence suggests something deeper is at play. The financial markets are whispering something that headlines haven't said yet. Trust is moving away from the dollar. So the real question becomes, how did the world's most trusted safe haven asset suddenly become the epicenter of risk? Who's selling the dollar? Who's still buying US stocks like there's no tomorrow? This isn't conspiracy theory, it's market evolution. And to understand what's driving this evolution, we need to roll back to where it all started. For decades, the US dollar has been the ultimate safe haven. But what happens when the safe haven becomes the source of the storm? That's exactly what unfolded, and the spark that lit the fuse was Donald Trump. Flashback to September of last year. The dollar started to rally hard. Why? On paper, the US economy looked decent. But more importantly, global investors were bracing for potential Trump victory and his unpredictable policies. So what did they do? They bought dollars, because when in doubt, you park your cash in greenbacks. But then came the shock. Trump's actual policies were way more aggressive than anyone expected. He unleashed a barrage of tariffs. Loud, fast, and global. And suddenly, the dollar flipped from being a shield to becoming a spearhead of uncertainty. Investors looked around and realized, wait a second, I came here for a shelter, and now the roof is leaking? In the first half of the year, the dollar saw not one but two vertical planks. And both had one thing in common: Trump-driven trade policy chaos. These sharp drops weren't random, they were the market's direct response to unpredictable White House maneuvers. Take a look at the VIX, the fear index, and overlay in with the dollar index. They used to move in opposite directions, and now VIX jumps, dollar tanks. That's a complete reversal from historical behavior. It tells you something critical. People no longer see the dollar as a hedge, they see it as a hazard. Worse still, it's not just about short-term trade drama anymore. Around May, the market started worrying about deeper, longer-term risks. Can the US government keep up with its debt? Will inflation spiral out of control? Is Washington losing its credibility? These concerns triggered a sell-off in long-dated US treasuries. Yields shot up. But unlike before, the dollar didn't follow. And why? Because trust broke down. Higher yields used to attract foreign capital. Not anymore. Now it's you're offering more interest, well, cool, still not buying. That's why we saw the bizarre divergence between the dollar and long term treasury yields. It's like watching two best friends suddenly ghost each other. Same data, opposite reactions. The financial ecosystem is splintering, and the dollar is no longer the golden boy. At this point, you might be wondering, if the dollar is so shaky, why are US stocks soaring? Isn't that a contradiction? Well, not quite. The market may have lost faith in the US government, but is still believing US corporations. You've probably seen the headlines. US stocks are on a tear this year, but here's the odd part. While the market soar, the dollar continues to slump. It's like watching Apple stocks hit all the time highs, while the greenback does a face plant. Sounds contradictory, right? Actually, it makes perfect sense. The key word here is hedging. Traditionally, when foreign investors wanted a slice of the US equity pie, they had to convert their local currency into dollars. The currency conversion naturally created demand for the dollar. It's why historically stock rallies and dollar strength went hand in hand. But not this time. Let's say a fund manager in Tokyo wants to drop $1 billion into Nvidia. He believes in the AI boom, but he's not so confident about the dollar. So what does he do? He buys Nvidia stock, but simultaneously hedges his currency exposure by shorting the dollar and going long on the yen. Now, even if the dollar weakens, his investment is protected. This is hedged capital inflow. The money is still coming into US stocks, but it's not pushing up demand for dollars. That's the big difference this year. And the data backs this up. If you look at the breakdown of overseas inflows into US equity ETFs over the last 3 years, the shift is massive. Previously, more than 80% of foreign money came in without hedging. The dollar was seen as a bonus asset. But now, over 80% of inflows are hedged. That's a behavioral pivot of historic proportions. So, what's fueling this wave? Two letters: AI. From Nvidia to Microsoft, Meta to Google, and even surprise players like Oracle, the AI narrative has become a market religion. Valuations are shooting to the moon, often with little regard for fundamentals. At one point, Larry Ellison, Oracle's founder, briefly became the richest person in the world. Then, of course, Elon Musk reminded everyone who's boss. But here's the thing. This capital surge into AI stocks doesn't signal broad faith in the US economy. Investors are betting on US corporations, not US government stability. That's why the S&P 500 keeps climbing while the dollar keeps sliding. Assets remain attractive, but trust is being recalibrated. Most people think the Federal Reserve is a rational, data-driven institution, and it is, but it's also an emotional beast, constantly scanning for cues like a nervous driver watching the dashboard. And right now, the brightest blinking light is interest rate expectations. Since May, the main thing driving the dollar hasn't been Trump's unpredictability. It's been one simple question: will the Fed cut rates by December? That question is answered, or at least heavily influenced, by one monthly data point: the Non-Farm Payrolls Report, aka NFP. But recently, this data has gone haywire. We all know the Fed's dual mandate: stable prices and full employment. Inflation's been sticky but tolerable, so the market's been laser focused on jobs. And the NFP has become the proxy. If job growth slows, rate cuts are on the table. If jobs are strong, cuts get postponed. Sounds logical until you look at the numbers. Take this. 1 month, the initial NFP comes out saying 140,000 jobs added. A few weeks later, it's revised to 19,000. Then revised again to 13,000. That's not a margin of error. That's a total narrative collapse. Imagine weighing yourself Monday, and it says you lost 5 pounds. On Wednesday, it says you gained 3. On Friday, it says, just kidding, you actually gained 10. Are you on a diet or not? That's what the markets are dealing with. And because traders hang on every NFP number, even flawed data shakes the dollar like an earthquake. July's report was okay. Dollar surged. August, a disaster. Dollar cratered. This single metric is dragging the Fed. And the greenback, back and forth like a puppet. It got to bad that even Trump stepped in, accusing the Labor Department of manipulating data and firing the bureau chief. Now, that might sound conspirational, but the underlying issue is real.
Look at before the election, the same kind of thing happened. And I think you'll see some very interesting information come out. But you have to have honest reports. And when you look at those numbers, or when you look at just before the election, and then after the election, they corrected it by 8 or 900,000 jobs. Yeah, I would say so.
Why is it flawed? Two main reasons. One, the survey response rates have tanked post-COVID, making the initial estimates sketchy at best. And two, the data is extrapolated from a sample of businesses, not the full 160 million non-farm workforce. So even small miss rates can ripple through the markets. This means global investors are effectively reacting to data that's not only lagging, but may also be misleading. And yet, it still shaped Fed decisions, market sentiments, and the fate of the US dollar. It's like driving a Ferrari blindfolded, relying on a GPS that keeps shouting recalculating. If earlier we were dealing with messy data and volatile sentiment, now we've entered the political thriller stage of this story. For decades, the Federal Reserve has been regarded as the global standard for central bank independence. Its credibility practically defines the dollar's global trust. But lately, that pillar of independence is showing some serious cracks, thanks to Donald Trump. It's no longer just verbal attacks on Fed Chair Jerome Powell, calling him slow or ineffective. This time, Trump got hands-on. First, he threatened to fire Fed Governor Lisa Cook, citing sketchy mortgage disclosures, sounding more like a pretext than a scandal. Then, in August, following a sudden resignation of the board, Trump moved fast to install his longtime economic consigliere, Mullen. Yup, the same Mullen behind the Mar-a-Lago economic plan, an aggressive mix of tariffs, spending, and monetary pressure. And boy, did Mullen make an entrance. When the Fed cut rates by 25 basis points in September, he was the lone dissenter, voting for a deeper 50-point cut. On the Fed's anonymous dot plot of rate expectations, one dot stuck out like a sore thumb, signaling a dramatic divergence from the rest. Everyone knew who that dot belonged to. It's like watching a barbershop quartet where one guy suddenly starts belting death metal. Funny? Sure. But it's also a warning sign. Trump is trying to steer the Fed's wheel using his own bandmates. To the market, that's terrifying. If the Fed becomes politically captured, its signals lose all credibility. Forget data-driven, we'd be entering the era of Trump-driven. That's why the old dollar is losing its premium. The Fed's independence is at stake. So what's the market doing? Voting with its feet. The dollar's sliding, US stocks are climbing, gold is on fire, and money is quietly moving into emerging markets. What's next for the dollar? From a rate differential standpoint, Europe's pretty much done cutting. Japan's inching toward hikes. If the US cuts another 100 basis points, as the market expects, the dollar could keep weakening. Morgan Stanley's forecast: the dollar index may slide to 91 by the end of next year, another 10% drop. That would be music to the ears of emerging markets. A soft dollar means stronger local currencies, lighter debt burdens, and a flood of capital inflows. But let's not pop champagne just yet. History tells us this boom often comes with hangovers. The 1997 Asian crisis, the 1808 Latin America spike, every dollar easing cycle ends with someone getting burned. So the real question is this: are we heading into global renaissance or another ticking time bomb? That answer depends on whether the dollar remains a global standard or becomes just another tool in a political toolbox. This isn't just economics, it's a test of global trust. And all we can do for now is wait and watch. If you have a theory on what happens next, I'd like to hear it in the comments. If this gave you clarity, please like and subscribe to Lit Talks for more, and thanks for watching, and I'll see you on the next one. Bye!